Started. All right, recording is going. Welcome everybody to the foundation of bookkeeping. Learn how to record any transaction in your bookkeeping. This being part of the Bulletproof Bookkeeping with QuickBooks Online webinar series. Of course, the focus is on QuickBooks Online, but today's subject is really, we're going to post transactions in QuickBooks Online so you can see the examples of what we're describing. But obviously, you can figure out if you're using desktop software, for example, how you would post the same transaction, the equivalent, using the desktop software. The point, if anything, really is that we're looking at the foundation, we're looking at debits and credits, because if you can understand things from that side of it, then it doesn't matter what software you're using. The software is just like think of it as a cloak that you're putting over the debits and credits, right? Anytime I'm filling out a form, if I'm in QuickBooks Desktop or QuickBooks Online and I'm writing a check, what I'm doing in effect is I'm crediting the bank account, right? Because credits reduce assets or bank accounts, and I'm debiting whatever account I put in the detail section of that check, right? And so we want to get a foundation in those debits and credits because that will help us when we get into trickier transactions. And we're going to use T accounts, which are how you lay out your debits and credits, in order to help figure out how to record some of those trickier transactions. And when you get into that, then it's much easier to see by laying out the debits and credits where, and of course I'm going to walk through examples, but you'll see me plot out examples of how we take a transaction and we're not sure how everything needs to get recorded. We plot out the debits and credits that we are aware of, and then sometimes it's just a question of what do I need to balance, right? And those of you who are on this call a couple months back when we did the members only Q&A call for the Bulletproof Bookkeeping course, one of our members, Derek, had brought a question, and he had a very tricky situation. He had bought up somebody else's loan on a property. And so, there was, we knew what he paid for it. We knew what the loan receivable was going to be, but we had an extra credit in the form of, what really amounted to what was he going to collect over and above the principal amount, that we had to kind of round out in that entry. And so we kind of worked through the problem. It was a little more complicated than I just laid out there, but the bottom line at the end of the day was we had a credit sitting out there. And what we were able to figure out by laying it out in the raw debit and credit form was that what we really had was deferred income, right? And anytime you have deferred income, it's money you've received that you haven't earned yet. Then what you have is a credit, right? If I collect money in advance from a customer that I haven't earned yet, I'm debiting my bank account to increase my bank account, and my credit is a liability because I either have to give that money back or I have to perform, right? I have to do the thing that they paid me in advance for, and once I do that thing, then it's earned. Then it's no longer a liability. We take it out of the liability, and then we can pick up the income. And of course, what that also sort of underscores is that we're talking really accrual basis accounting, right? Because in cash basis, you don't record it until the money is either received or paid. And that's one of the reasons why I don't like the idea of trying to manage a business on a cash basis. I know we pay taxes on a cash basis, so it has its place, but I don't believe you can truly manage a business on a cash basis, because to do that is to ignore your receivables and payables, and that's an important part of the whole entire picture that's there in any company's set of books. So with that in mind, I want to lay out for you a few resources that I'm going to share with you when I post the recording of today's session. So the first thing is we have a video that's actually free. It's not part of the course. And I'm going to share my screen here so you can see what I'm talking about. So to get kind of an extra foundation in what we're going to be going over today, there's this post. And again, I'm going to give you the link, Bookkeeping Basics with QuickBooks Online. Okay, it's here listed under the fundamentals of bookkeeping. It's part of Nerd Buzz, which is, the free area of my site. You do need to register an account. I think all of you by now probably have one. And then you can access this. And this video walks you through a series of about 6 or 7 transactions using, and some of you are going to recognize this, using my T account template here. And it walks you through exactly as I just explained, the debits and credits of each transaction. And then I go into QuickBooks Online and post the transactions. So after confirming how the transaction balances using these T accounts, then you go into the software, post it. Now you've got an expectation set about exactly what you expect to see and where. and then you confirm it. And if it lines up with your expectations, great, it's probably right. If it doesn't line up with your expectations, then you might need to go back and see what's wrong, or why doesn't something look right. So I'm going to give you the link to this. It's about a 32-minute video. The next thing is, for those of you who are enrolled in the Bulletproof Bookkeeping with QuickBooks Online course, I encourage you to, I've given this link out many times, I'm going to give it out again to those of you who are here today. Use this catalog, because this catalog has the complete outline of the Bulletproof Bookkeeping with QuickBooks Online course. These links will only work if you're actually logged in. So first you have to go log in on my website, right? And then once you're logged in, and assuming, of course, that you are in fact enrolled in the Bulletproof Bookkeeping course, then these links will work. I want to direct your attention specifically to the hour-long video that I have here on the statement of cash flows, because it's really a lot more than the statement of cash flows. And what it is it's another hour-long deep dive that kind of takes what I did here in bookkeeping basics and takes it to, this is the basics. This is the beginning. This is accounting 101 debits and credits, or bookkeeping 101 debits and credits. This kind of takes it to the other extreme, where it's looking at the statement of cash flows, but similarly it walks through a series of transactions with the T accounts where we actually look at the impact on the balance sheet and the profit and loss statement, and of course the statement of cash flows, so that we can completely and thoroughly understand the cycle of a transaction in any given set of books. So if you can get through what we're going to do today, and the bookkeeping basics video, and this, then you will have a super solid foundation. And the goal here is, when you get this foundation, this is what I mean when I say you'll be able to record any transaction, because you'll learn how to think through the debits and credits. You'll learn how to look at a form in a product like QuickBooks or QuickBooks Online. And like I said, if I'm recording a check here, essentially the bank account that I've got listed here is what's being credited, right? And the categories that I list down here are what are being debited. Okay, and sometimes we'll do things where, a classic example that comes up a lot for me, because I work with a lot of realtors, is we're writing a check to pay an agent their commission, and then we're holding something back, right? So I might record their whole commission expense here, and let's say the commission they earned was $5,000, but I'm recouping some kind of an insurance premium or something like that, and so this might come in as a negative. Right? Maybe I'm holding back insurance or a transaction coordinator fee. There's a lot of this kind of stuff. So their net check is only $47.50. So what happens debit and credit wise is we credit Wells Fargo, we credit the bank account to reduce the bank account, and we debit any account that's here. But of course, if I have a negative number here, then what's a negative debit but actually a credit, right? And so let's walk through this one in the T accounts just to start with. So transaction number 1, all right, the amount is actually, we'll kind of split it up. We have $5,000, and then we have minus $250, right? So paid agent commission, recoup insurance premiums. Okay, so this is the scenario. Okay, and I'm going to hop in on the chat to address questions in a few minutes after I post this transaction and show you exactly, what this all looks like, right? So I'm going to clear out of this now without saving it, because I want to do the debits and credits first, and then we can walk through what this is going to look like when we post it in QuickBooks, okay? So again, both of these are transaction number 1, because we have to split the transaction up. First, we have to pay them the $5,000 commission. We have to record that whole $5,000 because that's what they need to get a 1099 for at the end of the year, right? But then we're recouping $250 because for whatever reason, that's our deal with the agent, that they're going to, pay or partially subsidize, the insurance that we pay for with these guys. Okay, so let's see what this looks like. So I've got any payment is coming out of the bank account, right? But the payment out of the bank account, remember, is the net of these two. So if I highlight both of these, right, because I'm in a spreadsheet, I can look way down at the bottom right, and I can see that the sum down here, right, I'm down here, the sum is $47.50. So that's the net effect to cash, right? So I go down here, and here's my bank account, So we're going to credit cash $47.50. And the way this is configured, you can see right away it populates. These account titles are linked to the T accounts down below. So as soon as I put the $47.50 here, I'll put the transaction number 1. The spreadsheet flows it over up to here, right? And so we see the bank account being credited for $47.50. By the time we're done entering any transaction, this has to balance. Debits have to equal credits, right? So what are the other two pieces of this? I have $5,000 going to an agent commission expense, right? Now, I probably don't have that in the T accounts here. So I'll just take this one. And again, everything's linked up. So if I go in and change the title in the T accounts, we'll call it agent commissions paid. Okay, this is an expense, right? So expense get debited, right? In that, what do you call it? In that bookkeeping basics with QuickBooks Online video, there's a section of it in the beginning that goes over, in case you need the review, debits and credits. And I'll do a quick review with you in a minute of that, in a minute from now. So $5,000 is the expense. That's the amount of commissions expense we've just incurred because we're paying the agent $5,000. So I put in transaction number 1, the debit of $5,000, and that shows up here. Right, so we're not quite balanced yet, right? I have a difference, of course, of $250 because we have to deal with this piece, right? So we need an insurance expense. Let me see if I have insurance in here. If not, I'll go steal another account and create it. All right, so let's just, we're probably going to need loans payable. Let's go a little further. Here we go. We'll get rid of software development costs. Okay, and now we're recouping insurance expense, right? So we're reducing the expense. Somewhere previously, presumably we pay an insurance premium to some insurance carrier, and that would be the debit, right? Because we would debit insurance expense when we incur the expense. So now when we're recouping the expense or a portion of it from the agent, that's a credit. We're actually reducing insurance expense. Remember, as I explained earlier, in that detail section of the check, if the detail section are normally debits, then a negative amount in that section, of course, is a credit, right? So this is also transaction number 1. I'm crediting insurance expense for $250. And then we always want to come here and check that, sure enough, we balance, right? I've got 5,000 in debits, 5,000 in credits. And up here, you can see it all laid out. We credited the bank account for the net of $47.50. Agent commissions paid is $5,000. That's the expense. And then the recoupment of the insurance expenses, here's a credit for the $250. And then let me just check on something here real quick. You should all be able to unmute if you want to ask a question, because I see a comment in the chat asking if people are able to talk. So you come in muted, but you should be able to unmute. Anyone? Courtney, can you unmute? Let's try you.
Yes, I can.
Okay, so if you can, then well, you're a co-host though, so
Yeah.
let's see if somebody else can.
Melissa, I can unmute.
All right, perfect. All right, just making sure. So yeah, if a question pops up, of course you can put it in the chat, and I'll monitor that. But feel free to interrupt me, right? Especially if I'm like going hot on something, and you have a question specifically about what I'm discussing, right?
As a call-in listener, I just clicked allow to talk in case they.
Okay, yeah, that may be a little different, but yeah,
Okay.
That's fine. It could be that somebody's in by phone as well as by computer. They're using their phone for the audio part, which is fine. Okay, so I'm going to go back to sharing my screen, and let me do my super quick review of debits and credits and how that works, right? And actually, I might be able to pull in the example real quick from another place. Let's go there. 1 second. There we go. Nope, sorry, that didn't have it. 1 more second. There we go. This is perfect. All right, I'm going to copy and paste this in here. So this is kind of your quick review of T accounts. Basically, there are 5 different account types. Every account that you ever see on any company's chart of accounts can be grouped in this category, right? So in one of these categories, I mean. And I gave you some examples in this template, right? So examples of assets: bank accounts, accounts receivable, other current assets. These are things you own or have rights to, okay? Liabilities is the opposite. It's obligations you have to pay others: accounts payable, credit cards, payroll liabilities, loans. Anything that you owe out to others is a liability. Okay. Equity essentially represents the difference between the two. Assets minus liabilities equals equity. It's also known as the book value of the business. And that those examples are things like owner's equity, distributions, contributions, shareholder capital. There's a lot of different names that really mean different forms of equity, and the nomenclature of the names just change based on the type of entity it is. So if I have a corporation, it's shareholder contributions and shareholder distributions. If I have an LLC, it's member contributions or member distributions. If it's a sole proprietor, then it's just owner contributions or owner distributions, and so on and so forth. They all really mean the same thing at the end of the day. We just use different names based on the type of entity that we're looking at. Then, of course, we have revenue and expenses, which most of you should have a pretty easy time with, right? Revenue are the income accounts that represent money we've earned for whatever it is that we sell, and expenses is kind of the opposite. Cost of goods sold, you might think, is missing from here. Technically, cost of goods sold is really what's called a contra income or contra revenue account. Contra meaning it goes against, right? So because cost of goods sold goes right underneath your income as a P&L to show the direct charge off against income, so that we can arrive at our gross profit. So cost of goods sold technically is a revenue type of account. It's just typically negative revenue in effect, right? And over here you can see debit and credit wise for each of these 5 account types, what increases that account. So assets, exactly the opposite of what the banks have us thinking, right? They're increased by debits. The bank, when they give you money, they tell you they're giving you credit advice. They're really giving it to you from their own perspective, right? So it's the exact opposite for assets than what banks have you think. So debits increase asset accounts. Credits increase all 3 of these, the next 3 accounts: the liabilities, equity, and revenue. So liabilities, equity, and revenue are all increased by credits. And then expenses are increased by debits. So an easy way to remember this, after a while, it's just going to sink in, especially if you go through these kind of exercises like I'm walking through today. But after a while, it'll start to sink in. And an easy way to remember is debits increase assets and expenses. If you just remember that, then you can easily derive from that that everything else is increased by a credit, right? So debits increase assets and expenses. Everything else is increased by a credit, right? So if you're not familiar with this, I'll leave this tab in here so that you can get this review, when you're looking at this later on. Why is it not letting me change the order of these? There we go. And this will, so if what I just went through didn't make a lot of sense, hopefully now it makes a little more sense, right? So let me just look at the chat. Some questions. Robin asked, do I prefer Google Sheets or Excel? I teach Excel in Santa Monica, but most of my spreadsheets are done in G Sheets. That's true. So the Google Sheets option is preferable to me in most cases these days because it's, well, for the obvious reasons. The collaboration, the fact that it's in the cloud, it's easy to share. I can give you a view-only version, which when you get it, you can easily just click File and make a copy to make your own. So there's a lot of reasons I prefer the cloud version of almost anything in 2020, right? Including the cloud version of QuickBooks, QuickBooks Online. It provides a lot of convenience and efficiency in terms of working. The reason I still teach Excel at Santa Monica College is because a lot of people are still kind of hooked on Excel. And so it's in the works to also teach, some of the Google Doc equivalents. So we're going to teach Excel, and then we're going to teach Google Sheets. And so I'm working actually with the college on developing a curriculum for that. But for now, it's, a lot of people are just used to Excel. So I'm teaching Excel where I can, but believe me, during those Excel classes, I work in a lot of comments about the fact that there's a lot that you can do with much greater ease when you're using Google Sheets, right? It's easier, it's collaborative, it's in the cloud, it's easier to access, easier to share. I can have somebody else come into the spreadsheet right now and in real time start editing stuff with me, right? So now let's go post this transaction in QuickBooks Online, right? Because again, we had the debit to the commission account the credit to the insurance premiums expense account, and the net of these two was the net credit to cash, right? That's how it balances. We credit cash or the bank account for the net. I debit the expense for the commissions paid. I credit this insurance expense for the amount that we recouped from the agent on that. Okay, so before we run anything, I just want to run a quick trial balance because this is my sample books, and I don't remember, honestly, if I gutted it out from the last time I did a tutorial of any kind. So we're just going to change this to all dates and run it. And so it looks like I have some residual stuff in here from the last time I did a video using this company, okay? So we're gonna leave this here so we kind of see what we started with. And I love the trial balance report for this reason because it gives you everything across both balance sheet and P&L, right? And it balances everything perfectly. So what I'm gonna do is I'm gonna post date things so that I can carve out a trial balance for just a period, right? Let's go this year to date on this, and it looks like it's about the same. All right, so I'm going to duplicate this tab, and I'm going to duplicate it one more time. Okay, and then while I'm doing this, feel free to think up a complicated transaction that you may have encountered recently or a long time ago, whatever, and try and stump me. Let's see if we can't work through the debits and credits and then how to post it in QuickBooks, right? So this is going to be the balance sheet, and this is going to be the profit and loss. Okay, and everything is run from this year to date. I've got that set up by default. Okay, so let's go create that check. And actually, one more time. I want to keep my place here so we can see. For example, I don't have, there's commissions paid. So we know we're starting with $48,000. We know after I post what I'm about to post, this needs to be increased by $5,000, right? Insurance, we're going to see get reduced by $250. And then cash is going to get reduced by that net of $47.50. Whenever I'm posting something like this, especially if I'm in this kind of a learning mode and I want to make sure I understand things correctly, I always do this. I always look at the trial balance and or I can look at the balance sheet, right? The balance sheet and the P&L just kind of divide up what's otherwise on the trial balance. And I look at these things and I try and predict what's going to happen to these statements after I post this transaction, because having that expectation set will help you become much more clear on when something doesn't look right, when it doesn't look like, you know, the transaction posted the way that we had counted on. So we'll go create a check. Okay, the payee would be, of course, some agent, Agent X. Okay, there's the bank account. Let's just date this on June 1st. Like I said, I'm going to post date things just so I can force a trial balance that shows, you know, only that activity. The category again, commissions paid, right? Cost of goods sold. Remember, especially if we're dealing with a real estate concern, you have different commissions accounts. So you got to be careful and look on the right and see which account type do I want. It's not commissions income. It's definitely not the commissions clearing. That's how we clear commissions through escrow. It's commissions paid. Okay, the amount of the agent's commission is $5,000 in the example. If this were a real example in the customer, I would list the name of the property. Then I have insurance, minus $250, okay? Now, once again, here's my net total check amount, right? The net is $47.50. That's my credit to cash or to the bank account. I'm debiting this account, whatever account I put here. In this case, it's commissions paid, cost of goods sold. I'm debiting that $5,000, right? Cost of goods sold accounts work. Remember, they're contra to income, which means they work like expenses, right? So if we go back to our example, I told you cost of goods sold was really a revenue account, but it's contra revenue, right? So it's the opposite of revenue, which means cost of goods sold works like expenses. They're increased by debits. Okay, so here a negative debit is a credit. So we're crediting the insurance expense, which means if it's an expense account, expenses are increased by debits. If we're crediting the expense account, that means we're reducing it. We're decreasing the expense amount. Okay, so again, looking over here at the profit and loss, right now, year to date, I have $500. You know what? let me not post date it so that we'll see the impact actually in the current financials. So let me just date it with today's date. Okay, because then we'll see very clearly how the insurance amount, $500, will get reduced by $250, right? We'll see the agent commissions paid go from $48,000 to $53. And of course, we'll see cash on the balance sheet get reduced by the $362,000. Let's hit save and close and see if I'm right. Okay, so Wells Fargo account did go down, right? There's my commissions paid, went to 53 exactly as predicted. Insurance expense went from 500 down to 250, again, exactly as predicted, okay? Now I wanna show you something else that's really important and cool because it's really gonna help you confirm when you post something and you're trying to make sure you understand this part, right? Here's what you can do. And QuickBooks Desktop has a version of this as well. It's been so long since I've done it that I can't tell you from memory exactly where. If I was looking at a desktop check that we wrote, I could show you where to go to find it. But here, what we can do in QuickBooks Online is here where it says more. So I went in and I just edited the check that we just wrote. And if I click on more, I can run the transaction journal. And what this does is it exactly gives me the debits and credits of this transaction, right? It's exactly that. It's the journal entry for this transaction. You can do this for any transaction in QuickBooks Online, right? Any transaction, you can get the transaction journal. Okay, so here it is. We credited cash for $47.50. We debited commissions paid for $5,000, and we credited insurance for $250. So this should line up exactly with what I laid out here, right? And sure enough, it does. Okay, so this is huge. And sometimes I've had clients come in and say, well, you know, I don't think my cost of goods sold is being accounted for correctly. And this is the way that I've gone in often and improved it. So I would go into an invoice that they posted, which is how cost of goods sold gets posted, right? We post the sale of inventory. So we reduce the inventory asset by the cost of those items. And that reduction or credit to the inventory asset is offset by a debit to cost of goods sold. And I can show them that, and I can show it to them in this transaction journal by product sold. And I can say, okay, does this look like it's the right amount of cost of goods sold for these products? And if we need to, we can dig even deeper and confirm that. And so in many cases, I've been able to either A, confirm that it was calculating the right amount of cost of goods sold, or B, in cases where it clearly wasn't, usually what that's led me to, and you have to do some digging with the client to figure this out, is that in many cases, in almost every case actually, it's been because they weren't caught up on entering all the bills for the purchases of that inventory. So QuickBooks didn't have the right values associated with that inventory and therefore with that cost of goods sold. So using this is a really good way to audit the transactions to figure out, A, if something's wrong, and if it is wrong, you can dig in deeper and figure out why. So I'm looking at the chat. So can I teach accounting for software companies? If I want to start a bookkeeping business, can you just support me in situations where I have questions? I have purchased or paid for courses and consultation in the past, but could not spend the time to avail it. Can I get those courses again? I'm sorry, I'm not totally clear on what the actual question is. If you've paid for courses with me, then you should have access to those. And if you want to start a bookkeeping business, can I support you? Sure, I have support plans, or the Bulletproof Bookkeeping with QuickBooks Online course is sort of designed for somebody who wants to, build or run and grow a bookkeeping business.
Hello?
So, yeah.
Hello?
Hello? All right, I hear somebody, but I don't know if they mean to be.
You need to mute. You need to mute.
All right, never mind. I think that was just somebody that didn't have their sound muted. All right, so let's go back to this, and then we'll go back to, it looked like there's a couple more questions in the chat. Let me go back to that. Okay, so I noticed you're using opening balance equity. I've been told by other CPAs we should never use that account. Do I actually use this account, and why? So yeah, first of all, never say never, because anytime you do, somebody's going to find a way to prove you wrong. You know, I do use it sometimes. It depends. If let's say, and here's a classic case of when I do use it. First of all, if I'm setting up a brand new set of books for an existing business, then I very possibly am going to need the open balance equity account to do exactly that, to get those starting balances on the books. So if I'm setting up the beginning bank balance, then I'm going to debit the bank account for whatever its beginning bank balance is, and I'm going to credit opening balance equity, right? I could credit, you know, the contributions account instead, because we can look at it that way, that we're taking that beginning balance and showing, and it's really like they're contributing it into this new set of books. Not totally accurate to do that. But so yes, the answer is I do. It's rare. I avoid it. This is a sample company, so I probably, in my initial deposits, when I drop those in, I probably used opening balance equity for that. So if we go into the bank account register here, and sure enough, that's what the opening balance equity is. It's exactly that. This is really the one and only use case where I'll say it is acceptable to use opening balance equity. Is I'm starting a new set of books for this company as of January 1st. The company was already in existence, but you know, how many times do we get clients come in the door, the books are a mess and they're so bad that it makes more sense to start a new company file than to try and clean up what they have. And so I will set it up exactly this way. You know, I'll set it up as opening balance equity. Like I said, you could theoretically, if you really just don't want to use opening balance equity, you can call it contributions, because that's the, like I said, the way I think of it is that the owner is now contributing whatever this beginning balance is into the business. They're really not. It's just a new set of books for an existing business. So that's the answer on opening balance equity. All right, so Robin says, stump the teacher. S-Corp owner went to pick up materials and had to pay COD, so he used his personal credit card to pay. Amount was $4,280. There is a PO for the materials. All right, so I'll show you exactly how we deal with that. And there's actually a couple different ways you can approach this. So let's go into, let's just start with the chart of accounts. Okay, so we're saying there is a PO for the materials. So first, let's go create the PO. So new vendor's purchase order. Oh, we'll go turn it on. So purchase orders are something you have to turn on in the settings. All right, but it gave me the link, takes me right in. Now I can confirm. I'm going to use purchase order. Save. Back out here. New vendor's purchase order. So, and actually, before I actually do this, what do you think happens in the T accounts on a purchase order? PO for $4,280 in materials. Anyone? It sounds like somebody's unmuted. What's my debit? What's my credit? All right. Going once, going twice. It's a trick question. The answer is absolutely nothing. There's no debit, no credit. It's a purchase order. Nothing's actually happened. All I've done is place an order. I haven't bought anything. I haven't paid for anything. I don't even owe anybody anything yet. All I've done is called up my supplier and said, hey, I need these materials, right? So that's a trick question. There's nothing to post here yet. But QuickBooks gives you the form so you can create the placeholder so you have a record of the fact that we placed this order, right? So let's see if I have some supplier, I supply. Perfect. Okay, so we're entering the purchase order. Let's say the purchase order happened beginning of May. Okay, we'll just use category details. We'll say it's office supplies. You didn't specify what kind of supplies, $4,280, okay? Save and close. And yes, and we'll notice nothing's happened here, right? Here's my trial balance. If anything, if it were a posting type of transaction, we would have seen an increase to office supplies here, right? But like I said, it's non-posting. It's just a purchase order. It's nothing more than a placeholder, okay? So now we get to the next part of the problem, which is, okay, so the owner went to pick up the materials and he had to pay COD, so he used his personal credit card to pay for this, okay? So there's a couple of ways we can do this. I recently did a video where the title is quite literally, if you commingle business and personal expenses. And it goes through a really clean workflow that I've developed for how to handle this, especially if this kind of thing happens a lot. And so that newest way of handling things is that we actually create a credit card account on the books, not for his personal credit card. It's a fictitious account. And basically what I'm driving at is we treat it as an expense report. If you think for a minute, and imagine that the owner was not the owner, but just an employee of the company who used personal funds to pay for something on behalf of the business, what's he going to do? He's going to submit an expense report and he's going to get reimbursed, right? So if you think of the owner as being in that same role, just because he's the owner doesn't matter. The owner of the company is also an employee of that company. Forget about whether or not there's actually payroll. The reality is every owner of every company sort of fits both of those roles, as owner as well as an employee of the company, right? In most cases, they should be an employee, especially if it's an S Corp, right? Because she even said S Corp. So in that case, actually, he's definitely got to be an employee because S Corp owners have to pay officers' salaries, right? So bottom line, he's an owner of the company. Here's what I think is the cleanest workflow for this. So we're actually going to go over to the chart of accounts. Okay, and then let's go back to my T accounts here, right? So this was the trick question. Nothing happens. POs are non-posting, okay? Transaction 3, 4280, owner pays with personal credit card, okay? So let's do debits and credits. So we have their materials or supplies. We called it office supplies, right? So we know what the debit is, right? For transaction number 3, the debit is going to be to office supplies expense. Do I have that? I think I probably do. Yeah. So there it is. So transaction 3, we know we have a debit to office supplies for, how much was it again? 4,280. The question is, what's the credit? Okay. And again, if we use my method here and we treat it like an expense report, right, then it's really going to be, you know, expense reports payable or something like that. That's what I'm going to show you how to set up in QuickBooks Online. And of course, it works the same way in QuickBooks Desktop for those who are still using desktop for this kind of stuff. So let me see what expense account I can replace. All right, customer deposits retailer sounds good. Probably not going to need that one here. So transaction 3, we're going to have a credit for 4280. And again, this is going to be we're going to set it up as a credit card, and you're going to see why in a minute. But we'll call it expense reports payable. And usually what I would do is put dash in the name of the person, right? Because you can do this for any employee, and you just set up a separate one for each. So I'll call it BO for business owner. Okay, so I've got my debit to office supplies, my credit to expense reports payable business owner, right? I should be in perfect balance now, and I am. Remember, this was originally 5,000 from the last transaction that was posted. So adding the 4280, my debits and credits still balance. There's my office supplies debit and my expense reports payable credit, right? Debits increase expenses, credits increase liabilities, okay? So in the chart of accounts, I'm going to create a new account, and we're going to call it a credit card. And again, I'll call this expense reports payable -BO. Okay, the type is a credit card, save and close. Now again, it's a fictitious credit card. It's not a real credit card. We're not going to get statements. We're not going to reconcile it. But I'll explain to you some of the benefits of doing it this way, and then I'll give you the link. Let me add it to my notes to give you the link to that video too. All right, so video, if you commingle business and personal, that'll be enough for me to remember. Okay, so expense reports payable, BO for business owner. So now what we're going to do, remember, she said there was a PO, so we recorded the PO, and that's important because we want to make sure when we record the payment of this expense that we do it and we pull the PO in, right? So I'm going to say new, and I'm going to say expense, and the payer was I supply. And as soon as I put in that payee, it brings up the purchase order over here. So now all I've got to do is say add. Okay, now the payment account is going to be that expense reports payable business owner. Okay, and it brings in, we've got the 4280. So what are we doing here? We're crediting, this is an expense, right? So we're crediting this account. Remember, earlier we looked at a situation where this was a bank account. We were crediting the bank account, which decreases a bank account. In this case, this is, again, this is still the account that's being credited in this transaction, whether it's an expense or a check. And in this case, we're crediting a liability account, a credit card account type, which is a liability. So we're increasing this liability called expense reports payable business owner. And we're debiting whatever's here, which in this case is now the office supplies and software expense account, right, for the same 4280. So I'm going to click save. And then that's just warning me about classes. And I purposely click save instead of save and close because now I want to run the transaction journal to make sure that this makes sense. And sure enough, I've credited the liability account 4280, and I've debited the office supplies and software 4280, exactly as I had predicted here with my T accounts. Now let me show you a couple of other things. First of all, let's go to my balance sheet, and I'll just click Run Report to refresh that. Okay, there's my expense reports payable, business owner. Now this way we can write a check to reimburse the business owner for this expense. And if I do that, it's just like as if I was paying off a credit card. I would write a check out of the bank account and pay off this expense reports payable business owner, right? If for some reason the owner says no, and if they're adamant that they don't want to get reimbursed, then of course we can record the a journal entry and reclass this amount out of expense reports payable, and we could close it out to shareholder contributions, right? Because this is a liability. So to reduce liabilities are increased by credits. To reduce a liability, we would debit this 4,280, and we would credit owner contributions 4,280. Because in effect, that's what happens when a business owner pays for something out of his own pocket on behalf of the business. It's like he contributed the cash into the business first, and then the business paid it, right? We're just skipping that middle step, and he went straight to, making the contribution into the business by purchasing stuff on behalf of the business using personal funds, right? So that's how I would do this actually today. I've taught other methods before, and just very quickly, oh, and by the way, the other reason I love this method is now I can actually go into my banking area and I can grab, and this is what my video goes over that I'm going to include the link to in the notes. I can grab a CSV download from that credit card, my personal credit card, right? And I can, in that CSV, I can pull out all the things that are not for the business, leaving me with just the things that went on the personal credit card that month that were on behalf of the business, right? And then I can do a file upload here. And when you do the file upload, you're going to select a file, you'll select a CSV. It's going to ask you which account in QuickBooks Online you're actually uploading to, and you can upload directly to that credit card account. Even though it's not a real credit card, QuickBooks doesn't know that. So you can trick QuickBooks and you can do the CSV upload. So in an instant, you can import all of those expenses that they paid on their personal credit card that month from that CSV, import it. It's going to show up just like the transaction we just did as part of the expense reports payable. Let me X out of this. So all that will show up back in expense reports payable. And again, we can handle it the same exact way. As I said, we can either write the owner a check to reimburse the amount that's on this expense report, because we're just using the credit card account type as a vehicle for tracking expense reports, essentially. And I think it's a brilliant way to do it, because like I said, you can easily do an import, right, using what I just showed you. And so you can grab all the business related stuff that was on their personal credit card that month, import it in 2 seconds. It's all coded. You can even, just like any other bank feed, you can create rules so it starts to recognize if this is something that goes on every month. And it's just a nice, clean workflow, like I said. And then at the end of the day, you have a choice. Either write him a check to pay him whatever amount is in here at the end of the month, or close it out to owner contributions or shareholder contributions. Either way, you just want to make sure this gets zeroed out at the end of every month, so that on any actual balance sheet date, when you're looking at a monthly balance sheet, this will zero out, right? So you do want to close it out monthly one way or the other. Like I said, either by writing the owner a check or by closing out to shareholder contributions. So, and like I said, the video I gave you walks through a whole process, and if you access it on my website, you'll even get, I think I included a sample CSV download, but better than that, just download your own CSV file from your own bank or credit card, and you can practice that way. So that's why it's always good to have, the one nice thing about desktop is it doesn't cost you any extra to create like sample dummy companies for you to play with. QuickBooks Online, of course, you have to pay for a company, if anything, to play around. Although if you're an accountant or bookkeeper, you should absolutely have QuickBooks Online Accountant, which means you get your own free company and you can use that as your sandbox, as your playground, if you're not going to use it for your own firm's actual books. All right, so I'm gauging by Robin's response in the chat where she says beautiful in all caps that she likes my answer and that settles that. So does anybody else have any challenges for me in terms of transactions that we can work through here? We've got just a few minutes left in the hour. Come on, stump me. I dare you. That just reminded me, years ago, I was in the process of possibly hiring somebody to help me facilitate some of my one-on-ones. And we were right up to the point I was going to put his profile up on my website and hold him out as an instructor of mine. And I told him, I said, before I hit the publish button on this page, I said, you have to be confident that you can't be stumped. And as soon as I put it to him like that, he says, better hold off. He wasn't that confident, because I said, you can't, for especially the rates we charge, frankly, for a one-on-one, I was like, you can't tell people at that rate that you're going to have to check with me on something. Like you need that confidence that you can actually answer the questions. I mean, certain point I can see it, but all right, now we're getting some suggestions. Now I don't have time left for all that. I'm just kidding. All right, so a new finance vehicle with trade-in. I've actually got a video on that. I did it years ago and it was based on the desktop version, but it all of course works the same. Let me look at these and see which one I can easily do in like less than 5 minutes. Remove a 2018 bill in the amount of $55 in 2020. And then we have, again, new vehicle. Okay, so now we have some numbers. New vehicle, 30K trade-in valued at $2,500. All right, let me see if I can bang through that one real quick. New vehicle, 30K trade-in valued at $500. All right, so let's go back here. And we'll go into my T accounts. All right, and then let's paste that in. Perfect. So we've got a few things here. So we have a new vehicle that we're buying for $30,000, and we've got a trade-in for $2,500. So it's really $30,000. Okay. And then I'm going to hold the trade-in part aside for a minute. Okay, and the quick answer to that is the trade-in is really just a method of payment, right? So of course the question is that I have to ask to qualify this sort of is, are we assuming this is a vehicle that was on the company's balance sheet that we're trading in? Or is the owner just like taking his personal vehicle and trading it in, right? If it's something that's on the owner's balance sheet, there's a few more steps. I don't know if I have time to do it all right here, right now, because basically we would have to take the vehicle on the balance sheet, right? We would have to zero it out for whatever its original purchase cost was. We would have to recapture whatever depreciation had been recorded on that vehicle to date, right? And the difference between that and the value that we're getting for it in effect, which is $2,500, is the gain or loss on the disposal of that asset. So that one's a little more complicated than I think we have time to do here, because I do need to finish up in the next like 5 minutes. But I'll go through what I can of this. So let's hold that part aside. Let's forget for a minute about the fact that we have to write the traded-in vehicle off the books, and let's just deal with the purchase of the new vehicle, right? So we're going to debit an asset for $30,000 for the new vehicle. So let's start there. Okay, and let me just see. We're not using accounts receivable. So we'll have an asset account called vehicles, right? And debiting $30,000, okay? Now, a trade-in is really nothing more than a method of payment, right? Just like when somebody redeems a gift card. That gift card is just a method of payment that we're honoring, right? So in effect, we're trading in a vehicle for $2,500, and this is going to be, wait, what transaction number? 4. Okay, so hold that thought, because then the other question is, how are we paying for the rest of this, right? Are we financing? Are we putting any cash up? So we need a few more pieces of the puzzle, but let's just assume, since there was no additional information provided, let's assume the whole thing was financed, right? So now I have a loan payable for my vehicle. Let's use this one here for that. Okay, and in effect, that loan payable, let's just say, is going to be the difference. Okay, so the loan payable is going to be a credit for the $30,000 cost of the vehicle less the $2,500 we're getting for a trade-in, right? So let's just quickly do it here. Okay, so $27,500 is the credit so far. Okay, so we're still out of balance, right? What's that minus that by the 2,500? So the question is, where does the, how do we account for the 2,500? Right? This is 39, this is 36. We have what I call an unidentified flying credit, or a UFC, right? Okay, so we have to put that in somewhere. Now, a credit is the method of payment. So again, the credit ultimately would come from the fact that we're writing off this car that we had on the books that we've just traded in, right? So let's say we don't have the trading, because like I said, that introduces more complexities that I don't have time to get into right now, because we would have to go through that whole process. Once we dealt with the gain or loss on disposal, we'd be left with the 2,500. Ultimately, that would be coming off by way of crediting an asset account, right? Credits reduce assets for the original vehicle. So let's just say the 2,500 instead of a trade-in was coming out in cash, right? Just to keep things simple enough to cover it properly in the amount of time that we have. So that would be here. It would be a credit to cash for 2,500. And now, of course, we balance perfectly. Okay, so that's how we would deal with that. Again, with the caveat being that in the situation where we actually traded the vehicle in, I would need probably another 10 minutes to go through and show you how to, again, we need the original cost of the vehicle. We need to know the depreciation that's been recorded on that vehicle, because when we write off the original cost and then also write off the related depreciation, the difference is the gain or loss, and then we can boil it down to how we get to the 2,500 that we're getting for the vehicle. We're basically getting that back from the dealership, right? The other way of looking at that is it's like a credit to the purchase price. It's really not, though. We really got a vehicle valued at $30,000, and we got a method of payment by giving them a car in the amount of 2,500, right? And so 2,500 is the consideration you're receiving in effect for the disposal of that vehicle. Like I said, it's not infinitely more complicated, but it's more complicated, right? So that's about all the time we have. Robin says I can carry over the car trade-in piece next time, and yes, I will definitely include in my notes the video for the car purchase transaction. If the company started in January 2020, has invoices to send to customers and receive payments. All right, let me come back to that, because I saw another question earlier. So how do we remove a bill from 2018 if it's now 2020 and the bill is never going to get paid off? What I usually do, because we don't want to mess with books from a closed period, is I would record a bill credit on January 1st of 2020 and apply it to that bill, right? And then you just write it off. Now, one thing I've started to use in recent years that I love for this kind of thing, oftentimes if it's something like that with a bill, when you do the bill credit, you could simply record that bill credit. In this case, it would be like a vendor credit. Let me see something for a second. Can we do it from the bill and just say, no, in QuickBooks Desktop, there's an option you can check off that says this is a bill credit. So you would do a vendor credit, and you would do it to whatever expense account would have been used when that bill was originally posted 2 years ago. But you would date the vendor credit January 1st of 2020. That's kind of like a good cleanup date, because it's New Year's Day in the United States, and so there's not usually a lot of transactions, recorded on that day. But the other way you can do it, especially if the amount is significant, is instead of using that same expense account that would have been used, because it kind of skews this year's financials, right? We're reducing an expense from something that happened 2 years ago. So one thing I have been doing a lot, and my CPA friends seem to love this, is we create a new account, and it's going to be an other expense, and we call it prior period adjustments. And what this does is it pushes that amount that's based on a prior period, that's based on prior period activity, to the very bottom of the P&L below the operating profits. in that P&L. And so what this allows us to do is still analyze what the normal operating profits of the company look like for that year without having to consider inside of that, stuff that we posted that affected a prior period. What this also does is it solves a big problem that often comes up because a lot of people end up posting things like that to retained earnings, which is the worst thing you can do. By running it through prior period adjustments, you're running it through this year's P&L. Ultimately, it will get closed out to retained earnings because the bottom line net income number will reflect those prior period adjustments. But this way, it'll close out to retained earnings in the proper way. So I love using the prior period adjustments account as an other expense because it goes below the line. It goes below the operating income line on the P&L, and it really carves it out. And this way, if there are questions, and there should be, we've got it sticking out like a sore thumb intentionally so that we can drive that conversation with the tax preparer and explain to them, yeah, this was us cleaning up stuff that was sitting in the books from 2 years ago that never got cleaned up, right? And that way they can consider how they want to deal with that on the actual tax return. So, that's my story, and I'm sticking to it. So I'm sorry, I should have asked sooner for you to give me questions because these are great questions. If the company started in January 2020, has invoices sent to customers and received payment in other accounting system, is it recommended to record invoices and payments or just record bank statements? Client came in May. So if there's another accounting system, then I think you really have to decide how you want to do that, right? Why are we doing double work? That would be my first question. There may be a good reason for it. Maybe the other accounting system has is a proprietary system for the industry that I'm in, and maybe it does a better job of handling the whole, the invoicing process. Maybe they have better looking invoices. I don't know, but so I need more details. But if that's the truth, if that's the case, then maybe I only need to do the simple version of that in QuickBooks Online. Maybe all I need is just like you suggested, just kind of reconciling the bank statements and making sure that the income that came in comes in as income. We do that a lot for law firms because law firms typically have billing software that they use that has all the details. And so in QuickBooks Online or whatever we're using, we just record the deposits they receive straight to income, verifying, of course, that those deposits do in fact only include income. So with that, I got to wrap up because I got to make sure we stop on time. But by all means, save your questions. If you're in the Bulletproof bookkeeping program, you can absolutely ask them in Slack, and I'll be more than happy to follow up in Slack on those questions. And maybe we'll do a part 2 of this. Next week is the members only Q&A only for people who've signed up for Bulletproof bookkeeping. So maybe the week after that, we'll do a part 2 of this, and then I'll encourage you to send in your questions in advance. This way we can work through them. So thanks again, everybody. Really appreciate you showing up. And like I said, reach out to me in whatever way you know how. There are many of them, many ways to get in touch with me, and I'm more than happy to follow up with you and get your questions answered.
Thanks, Seth. See you
Thank
next
you.
time.